Hi, I'm Bill Baruch, president of Blue Line Capital, and I'm here with our analyst, Jannis Meindl. And this is the Triple Play podcast. We're coming to you with some new material, some new chart books. We're excited. It's been a wild week in the markets, and we got a lot of information for you. So let's get to it. Jannis, why don't you take us away with the macro?
Yeah, thanks, Bill. I mean, who would have thought that we'd have this much information to cover? We'll keep it relatively brief, but just to touch on the major points that have unfolded since our last recording here. So we saw Silicon Valley Bank basically go under, and while there has been a lot of discussion around the reasons why that happened, ultimately it goes back to the duration risk that the company took with deposits. So if you're a depositor at a bank, you're ultimately in a creditor type position. So you put money in the bank goes out there and buys treasuries so they can pay you interest. That's exactly what Silicon Valley Bank, as their deposit base grew by 4.4x since 2017, their MBS, mortgage-backed securities holdings, expanded by about 6.5x. And they bought all these different mortgage-backed securities and treasury securities basically at the low-end yields and at the high-end treasury prices. So they had these massive unmarked losses on the treasury book. I think it was a disclosure that they had about 15 billion of unmarked losses in a footnote of an SEC filing that they had when they tried to raise money. And that ultimately triggered a bank run on Silicon Valley Bank. They couldn't meet the outflows. The bank went into FDIC receivership last Friday. And then over the weekend, we also saw regulators shut down Signature Bank. But this is ultimately a duration story. And as much as people try and connect Credit Suisse problems, a bank that has had problems for a long time, they're trying to restructure it. Saudi Arabian national banks coming to move in. They are separate problems, and you can't really make the analog back to 2008 during the Great Financial Crisis. This is a liquidity, not a solvency issue with Silicon Valley Bank here. The Fed, in conjunction with the Treasury, also instituted a bank term funding program, which allows banks to post MBS and Treasury securities at par as a collateral and in exchange meet deposit outflows. So Treasury and the Fed have acted extremely swiftly, I would argue, over the weekend and on Friday. And then here it's just illustrated in terms of why all of this duration mismatch happened. You had QE, you had a lot of Treasury securities get pumped onto the books of banks that didn't know what to do with the money that they received. So as an unintended consequence, they took on that duration risk, and that's what we're seeing right here. We'll cover it more in depth also as far as duration goes with one of our bank names in today's stock selection. But that's basically what unfolded. And then shifting to economic data here real quick, we had total non-farm payrolls come in at 311,000 job additions on Friday, while the job additions themselves were probably at the higher end. Wage trends are extremely encouraging. We saw that a lot of the wages do come in line with the 2% average inflation target. I think average hourly earnings annualized to 2.9%. So that's right in line with the Fed's 2% average inflation target. We saw a lot of the same theme across the inflation data. But Bill, I'll let you touch on that and what we got here this week.
Yeah, it's been like you said, interesting week. You covered quite a bit there. The CPI data was the first big number this week. Right as I'll point out, BTFP was what they named this to a discount window for the banks. Buy the freaking pivot, and that's really what we've seen. Coming from. And that's not what it means, but that's what we're taking it as here, because the Fed has ultimately pivoted. They've broke something. They've come in and protected this, and we've seen this extrapolate in the rate markets. But it's also the rate markets extrapolating less tightness from the Fed. It's also due to the inflation. So first, CPI data on Tuesday, it was right in line with expectations, but the good news, it was lower than January. So this February number is 6.0% headline year-over-year inflation. And that's a light at the end of the tunnel. And then the next day, Wednesday, we got PPI, and PPI was significantly less than expectations on the year-over-year basis. I think it was 4.4%. But the headline month over month disinflated by 1/10. So we're seeing some of that disinflation into the market. You combine all of this that's happened over the last week, and we've gone from last Tuesday when Fed Chair Powell was extremely hawkish in front of Congress. And they were pricing in 50 basis points of worth of hikes and a 5.75 terminal rate, 50 basis points of hikes next week. We've seen that completely flip. And we've seen a point where there was no hike at all next week being priced in. So right now things have settled in a little bit here today as the market surge higher, by the way. But things have settled in a little bit. We have odds that about 80% chance that they hike 25 basis points next week. But as we move into December, there's about 50 basis points worth of cuts from the level in which they leave it next week. So it'd be interesting to see. They get this thing back down to 4.25 to 4% maybe by the end of the year. We'll have to see where things kind of shake out. Is this an overreaction? But I think at the end of the day, we're seeing the numbers in the inflation. We had that sort of inflationary pulse to start the year, what we talked about, social evolution, and then now that's sort of calming down. The Fed's multiple 75 basis point hikes last year is going through the economy. It's starting to break some things. It's starting to slow the economy. Ironically, yesterday, the Atlanta Fed GDP did revise higher for Q1 to 3.2%, but that could come down a little bit. But you're seeing a lot of GDP revisions. And I think as the year unfolds, we'll see a little bit of slower growth. And our theme, I said this on CNBC yesterday, bring out your 2019 playbook. This is sort of what we really saw as the market sold off sharply in December 2018. Fed pivoted. They didn't cut rates right away, but they moved away from their hiking. They moved away from QT, and we then saw the market rally from that. And you had the Nasdaq rally 50% from basically in that window. So I think tech could lead higher. Let's dive into these stocks. So we don't have we're finished off with tech. We're not going to start off with tech, but we got Morgan Stanley to start off here, sticking with the bank theme. And Morgan Stanley is a name that we own. We are underweight tech. We own about 6%. I'm sorry, underweight banks and financials. We're about 6% to what was the S&P's weighting of about 10%. And the two names we have are big names. We don't own any regional exposure. We moved away from regional bank exposure at the turn of the year. Really just some uncertainty around the mortgage lending market. In fact, whether that would dry up, maybe there's some defaults, who knew? And I thought that, really we decided that let's concentrate that financial exposure in these large institutions that are too big to fail. Morgan Stanley, though, is really a nice one because we were like the diversified revenue streams. 50% of the revenues come from the wealth management. It's a juggernaut of a business that they have there. It's so that's right there is sort of insulated away from what we're seeing taking place in other banks that are leaning in sort of niche markets. 50% of revenues are in the wealth management. We also have their multiple is forward multiple 12.5 has come down a little bit from 14.5, the trailing, but they are a little bit of a premium to some of these other names like the Goldman and Bank of America and JP Morgan. And that's more due to some of the lending that the others do, some of the risks that the others may have with some lending. But overall, we like this name a lot. And, I think looking, the theme this week, we see the treasury exposure, we hear about the treasury exposure. Morgan Stanley is one of the least levered and least exposed to unmarked losses on their balance sheet due to these moves in bonds and fixed income markets. So I think it's a great place to be. I'll finish off with the chart. I love this chart. I'll let Jannis, why don't you step in here and tell us about what you think?
Yeah, a lot of good points made right there with sort of being more isolated from the overall liquidity concerns here in the banking space. A lot of eyes have moved on to how much unmarked losses there are on the held to maturity securities. That's what they call it on their balance sheets. And Morgan Stanley being of the ones that's least exposed, one of the ones that's least levered. So being less levered is always a good thing in stress scenarios. And then if we think about just the business, as you said, it's a juggernaut sort of asset that they have with wealth management making up 50% of their revenue. Then you have their broker-dealer side with equities and fixed income combined making up a little bit less than 40% of their revenue stream. We did see strong activity across the fixed income instruments that they trade as a result of the macro conditions that we're currently in. And I expect that to continue. So broker-dealer side in combination with wealth management setting for a positive outlook here for the bank. But then as we think about the banking space more broadly, you have to ask yourself where ultimately the income and the revenue is going to come from as they have to offer higher rates on deposits. And that ultimately compresses the spread in between the deposit rate and the loan rate. a bank makes its money by using the deposits that people put in the bank, then loaning that money out. And for a mortgage loan, auto loan, Morgan Stanley is not nearly as exposed as other banks to that space, but that's how they make their money. So you have to think about the net interest income that banks make. It's often referred to as the NIM, net interest margin, but that's something to consider here. And then I think generally speaking, moving from liquidity concerns to solvency concerns, as maybe there's a little bit of a renormalization on the delinquency side, as people might not be receiving those transfer payment checks, delinquency rates will probably normalize in some fashion. Charge-offs, meaning how much have banks written off from the outstanding loans, extremely low across the banking space. Morgan Stanley isn't exposed to that really that much, so we just use Bank of America, Wells Fargo, and JP Morgan here. But you can see the steady trend down as the economy has been quite healthy, as rates have been low. But maybe there'll be a little bit of an uptick. We've not really seen the uptick in terms of delinquencies on the 90-day delinquencies. However, what we have seen is more people transition into the 30-day delinquency. So people who cannot meet the credit card, auto loan payments, mortgage payments within 30 days, those have ticked up. So those are some of the initial signs. And you have to recall that really over the course of the last 2.5 years or so, income of a lot of people was really overstated because people have received a lot of transfer payments. So the credit score was maybe a little bit inflated, and we're just going through that renormalization. I think one thing to point out is that you don't necessarily have to feel like you are pushed into these names just because everybody's talking about them. Bill, I'll kick it back to you here.
Yeah, you said it, you don't got to be trying to buy the dip in banks. There's still a lot of uncertainty out there. I mean, yeah, there's money to make, but you just be patient with this stuff, and you don't necessarily, buy what's working. And we'll get to it when we talk about tech which is our third stock. But yeah, be patient with some of the stuff that's going on. You don't feel. A lot of people feel magnetized to what is moving in the markets, and right now it's just banks taking all the headlines. But with that said, XLF is your benchmark of financials. So we want to own the best relative to that. And you have a multi-year breakout. We're trading at multi-year highs relative, Morgan Stanley relative to the XLF. Trading at multi-year highs here, and it's breaking out. I mean, I don't think it gets better than this. This chart says it all about Morgan Stanley. We like the name, we're long the name, and we'll stay long the name until something changes. Moving on, though, here, United Health, we're going to cover here. This has been a portfolio cornerstone. It is for a lot of portfolios. We like the name. We've owned it. We haven't throttled it up and down as much as, say, a Thermo Fisher. It's been sort of a staple there. Outside the top 10, it's done really well. It's sort of a little bit of a fallback now. One of the really great things is their annual growth rate. Last year, 12%, and they've been growing revenues by 10% a year since 2017, and that's despite a stagnant membership. I mean, you got to think about it. You have a aging population that's also likely going to be making more insurance claims against a healthcare provider like this, and the revenues are still growing steadily. I think that's a terrific thing to see. The multiple is on the little bit of the higher end. You're paying a premium for this name. But it is lower than the trailing. So you have forward multiple at 18.5, the trailing multiple about 21.7. So it's down a little bit there. But it is a premium. Like Morgan Stanley, diversified revenue streams. United Healthcare, it has a number of businesses. They have the Optum Insights, which is their analytical business. It's revenue growth 20% in 2022, $14.6 billion in revenue. Their pharmaceutical, Optum RX, grew 9% revenues, approaching $100 billion for the year in revenue. Obviously, United Healthcare as a whole, $250 billion revenue, and growing at that 12% I mentioned. It's just a name. It's a comfortable name. It's a name that you have in your portfolio, and it was outpacing the market as it was going through. The broader market was going through all those trials and tribulations last year. United Healthcare was really sitting within inches of its record high. So, with that said, Jannis, what do you have for us on this name?
Yeah, there's not really a lot that I have to add on this one, but I would just generally point to the theme that we had coming into this year and on the back of COVID. What did everybody talk about what was everybody afraid of, it was really that there were a lot of surgeries that could not be done because there were more restrictions in terms of visiting hospitals or visiting doctors. And so a lot of people expected an uptick in surgeries and therefore a lot more insurance premium that has to be paid back out to patients. Ultimately, that didn't really happen. And comparing 2022 numbers with 2019 numbers on the medical care ratio, which is just a measure of how much of the premiums that United Healthcare receives goes back to patients, that is steady and in fact below 2019 levels. So that's an encouraging sign. And then, as you said, despite them not being able to expand their patient base on the insurance side, they have really have had more focus on cross-selling people onto their Optum platform, which is in some cases, especially in the Optum Insights front, a higher margin business. So I think it bodes well, although I don't have a strong opinion on the name at the moment, but I would say cross-selling is definitely an important aspect as you have an aging population where you maybe don't make as much revenue, not as much income on just the volume of patients, but rather what services are you offering? And that definitely seems to be a trend with this name. I'll already kick it back to you here, Bill.
Yeah, as I mentioned, the name itself, the price of the stock's coming a little bit, but I think we've got a good range here. And at above 400, which is at 382 from the 2020 low, the pandemic low. Obviously, it was one. It took that out in before July. It was June last year, kind of, and then really started just trending higher. It just sat there last year. A lot of the time, it sold off in June. It tested into really that sort of that zone. It struggled to extend gains. I think that's nice. A nice consolidation here above 400 to 550 is healthy. So we like it. Not a whole lot to take away from this chart, though. Let's move on. Finish off here with Adobe, who reported earnings yesterday. And I don't know how they're finishing, but it's been a tremendous day for tech. We're very overweight tech. We own Adobe, and I know a lot of the day was up, 4% or so roughly. But from the earnings side yesterday, 3.8 EPS versus 3.68 is estimated. 4.66 on the revenue versus 4.62 revenue estimated. Now, it's not just blowout. Those are not a blowout, but it is a beat. Double beat is great to see. And I noted on CNBC yesterday, the elephant in the room has been Figma and the purchase of this collaborative platform. And Jannis, off camera, I think you made a great comparison. It's like the Bloomberg terminal for sort of this design collaboration. And I think of people, how important web design and everything programming is becoming here. The internals of being the electronic face, the internet face of your company and building all this stuff. This is going to be a great platform for Adobe to have in their network. And then it opens up the other suites that they offer as well. So Figma, they have a $1 billion breakup fee if this does not go through, even if it's shot down by the government. So in February, I think it was February 24th, you saw Adobe sell off 7%. Due to some regulatory headwinds that arose. So the markets are, I think, digesting that this cannot go through. But one of the reasons why the stock is acting positively today on those earnings is they had positive comments. They think this will close by the end of the year. So that's something that's going to be obviously becoming a tailwind here for Adobe, despite the concerns of the breakup fee. They do have about $4 billion in cash. So it's you lose $1 billion, it's going to hurt you. I don't care, but they have the money. This goes in our tech theme, especially where you have the forward multiple at 21.8, trailing multiple 32.6. So you seeing that it's digested a lot of this. It's ready to move forward. It's not this excessive multiple high growth name, even though you're getting the growth out of it, especially the free cash flow margin growth. I mean, 36% in 2019, 42% last year. 43% expected for 2024. And here's the icing on the cake. What you take away from this whole week with what's going on in the banking sector, how a lot of these startups were pulling cash because they need to run their businesses. And the VC network for them is becoming tighter. And here's the thing, is there's going to be consolidation within the tech space, and money's going to flow to the bigger companies. Adobe is going to be a beneficiary of that. And I think that it's going to be a tailwind for years to come here as this space overall consolidates. Obviously, like you kind of see this with the Figma deal, and then they lose some competition outside of that network. You lose other competition with these consolidations. So I really like this name a lot. It's given us a lot that we want to see here in recent days. Jannis, why don't you take it away from here and tell us what you think?
Yeah, I agree with everything that you just said. So maybe we should just close it out. No, we'll cover a couple of more data points here. So Adobe and the SaaS space in general, software as a service, has been an extremely sexy space for the entirety of Wall Street here before rates rose. And now you have the more dominant players that are still in the space offered at lower multiples. I mean, if you look at a 21.8-ish multiple, that might be higher than the index, but it's an extremely high quality business with extremely high margins. If you look at the digital media segment, which is the Adobe Creative Cloud, the Adobe Document segment, both are major revenue drivers for the company. And digital media has a gross profit margin of 95% because the incremental sell that the company makes to customers, there's almost no cost associated with that. It's a software product that you provide. It's similar to the Microsoft Office suite that you can think about that in terms of. So you have seen last 12 months revenues continuing to increase by about 11%, although the revenue growth and the profit growth have ticked down. I would argue a lot of these trends have been baked in. And ultimately, if you look more broadly on a secular basis, you see that digital marketing spend is not going anywhere, and it's not going anywhere globally, where you see that this year maybe digital advertising spend is tracking down a little bit, although it's still expanding somewhere between 4 to 6%, depending on who you listen to. But over the long term, looking out to 2027, you have more than $1 trillion being put into digital ad spend, up from about, I think, $700 billion expected for this year. So you have solid growth in that space. And then you also have Adobe's exposure geographically diversified. They generate about 60% of their revenues in the Americas. And then so you have the 40% part of the cake of sorts that has a lot more expansion potential. If you just look at a simple figure, for instance, smartphone penetration in emerging markets stands at about 45%. According to Pew Research, and that's at 76% in developed markets. So these markets, they start off with the digital medium as a starting point. They don't even have to make that transition that maybe the developed world might have had to make in the transition to a more digital format. So you have them starting off at sort of this stepping stone where they are directly into the digital world. And then I see a lot of potential for growth for Adobe here outside the US, and exactly what you alluded to with the VC route and the VC route associated with the stress in the regional banking space. There will be a lot more consolidation as VC companies are a lot less eager to fund a lot of the different projects out there. I remember a lot of talk around competitors for Adobe before rates rose. And there was really a lot of concern around all these different startups that popped up all around, and whether they would take market share from Adobe. I think ultimately this is the strong players in the space getting stronger, the same way that the big banks are getting stronger as the regional banks are getting weaker. So you have the consolidation, you have extremely high cash flow visibility, you have a network effect, so exactly what you said with what the discussion we had offline. It's like a Bloomberg terminal. If you're once trained on the Adobe platform, you're not going anywhere, and that gives you a lot of visibility. But we'll close it out here, Bill. I'll take it back to you for the chart.
Yeah, this chart is, it's not like it's making highs or has made highs recently, like Morgan Stanley or United Healthcare. But what you're getting here is a potential bottoming process, a really nice bottoming process. The 50-day starting to move, through the 200-day potential shift in momentum. But the stock itself sold off at the end of February, like I said, because of that Figma deal. And you're getting that move right now today. That's right back in the 50-day. So if we can get some more momentum in this and through next week, this thing could really go. I think there's a lot of room to the upside. You get this nice big smile out of it, and it held the gap held out above the gap pretty good going back to November. After, I think that was that post CPI number. That was really good. Supported a lot of things at that time. But it's a good chart. It potentially coming out there good. We have a great chart book for you. As you saw, there's quite a few slides. Check it out. We always have a lot of information for you. We love to hear from you. We love to hear what you think of the Triple Play podcast. Reach out. Let's connect. But this was another great one. And thanks, Jannis. And yeah, if you have any questions, feel free to reach out. And we're always here to connect. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.